If you've opened YouTube or Twitter in the last 24 hours, you've probably seen the same words over and over again. Gold breakout, silver explosion, war premium, market crash in 48 hours. Some channels are calling for $3,000 gold immediately. Others are saying this is the top before a collapse. The headlines are loud, the emotions are loud, the positioning is crowded. So in this video, I'm going to slow it down. We're going to look at the actual data around the US-Iran escalation risk, the tariff ruling that dropped today, and what the bond market, the dollar, and positioning are actually telling us about gold and silver right now. No hype, no panic, just probabilities. Welcome back to Financial Briefing. Before we get into today's setup, let's do what we always do here, a quick accountability check. 3 weeks ago, when gold was pushing toward 2,150s and silver was pressing $34, I said the probability favored short-term consolidation rather than an immediate vertical breakout. Since then, gold has chopped sideways and silver retraced toward the low 32s before stabilizing. Not a crash. Not a moonshot. A digestion phase. That call worked. Back in March, when the 10-year yield spiked above 4.4%, I said rising real yields would likely cap gold temporarily. Gold stalled for about 2 weeks before resuming higher once yields cooled. Again, not dramatic, but directionally accurate. And in January, when silver dipped under $23 earlier in the year, I said downside looked limited given industrial demand and tight physical supply, assigning only a 25% probability to a sustained breakdown. Silver recovered sharply in the following months. That's not to say I get everything right, but we track probabilities, not emotions, and that's what we'll do again today. Let us start with the first data point, gold's current price behavior relative to geopolitical risk. As of this morning, gold is trading around $2,120 per ounce. That's roughly 2% above last week's close. Silver is near $33 per ounce, up about 3% on the week. Context matters here. During the initial Russia-Ukraine invasion shock in early 2022, gold rallied roughly 8% in 2 weeks. During the October 2023 Middle East flare-up, gold jumped nearly 10% in a month. So far, this move is modest by comparison. What it means is that the market is pricing in some geopolitical premium, but not full-scale war. There's concern, but not panic. The options market reflects elevated volatility, but not crisis-level skew. What it doesn't mean is that gold is guaranteed to explode higher if tensions escalate. Historically, geopolitical spikes often produce short-term rallies that fade once uncertainty stabilizes. Gold tends to price in fear quickly, and then retrace when the worst-case scenario doesn't materialize. Second data point, the 10-year Treasury yield. The US 10-year is sitting around 4.25%. That's down slightly from the recent 4.35% high, but still elevated relative to the 2023 average of roughly 3.8%. Historically, gold performs best when real yields fall sharply. In 2020, when real yields collapsed below almost 1%, gold surged to record highs. Today, real yields remain positive, around 1.7% depending on inflation expectations. What it means is that we do not currently have a classic monetary panic backdrop. This is not a Fed emergency easing cycle. This is not a liquidity flood. What it doesn't mean is that gold can't rise with yields elevated. We've seen in the past year that central bank buying and geopolitical hedging can support gold even when rates are relatively high, but it does cap the upside velocity. Third data point, the dollar index, DXY. The dollar index is hovering near 104.5. That's strong, but not extreme. For context, in late 2022, the DXY hit 114. That crushed gold temporarily. Right now, the dollar is firm, but not screaming higher. A strong dollar usually pressures gold and silver because it makes them more expensive globally. The fact that gold is holding above $2,400 with a firm dollar tells you underlying demand is real. What it means is that gold's strength isn't purely a dollar weakness story. There's diversification demand in play. What it doesn't mean is that the dollar can strengthen further if global risk increases. In an IO full risk-off event, capital often flows into both the dollar and treasuries, and sometimes gold competes with that flow rather than fully benefiting. Now let's lay out the bull case clearly. First, geopolitical escalation risk. If the US-Iran situation intensifies beyond rhetoric into sustained military engagement, safe haven demand spikes quickly. Gold could test $2,500. Silver, given its higher beta, could push toward $36, $38 in a short window. Second, central bank buying. Over the past 2 years, central banks have purchased over 1,000 tons of gold annually, historically high levels. That structural bid hasn't gone away. Third, tariff uncertainty. If today's tariff ruling expands trade friction, that increases inflation. Uncertainty and global fragmentation risk, both long-term bullish for gold as a neutral reserve asset. Fourth, retail momentum. If silver breaks above $35 decisively, technical traders pile in. The next resistance isn't until the high 30s. Add that up, and I assign roughly a 30% probability to a strong bullish breakout scenario over the next several weeks. Now the bear case. First, headline fatigue. Markets often overreact in the first 24-48 hours, and then fade the move as details clarify. If tensions de-escalate diplomatically, the fear premium unwinds quickly. Second, elevated yields. As I mentioned, real yields are still positive. If inflation expectations cool and yields tick back toward 4.4 or 4.5%, third, positioning is no longer light. Hedge funds have increased net long gold futures over the past month. That creates vulnerability to a shakeout. Fourth, silver's industrial exposure. About half of silver demand is industrial. If tariffs slow global trade expectations, silver could underperform gold in a risk-off environment. Combining those factors, I give roughly a 35% probability that this move fizzles, and we see a pullback of 5 to 10% in both metals. Which brings me to the middle case, the one I currently view as most likely. My base case, around 40% probability, is that gold trades between $2,350 and $2,500 over the next month. Silver likely ranges between $30 and $36. In this scenario, geopolitical rhetoric remains elevated but contained. Tariff impacts are digested gradually. The Fed stays patient. No emergency rate cuts, no dramatic tightening. That produces volatility, not trend acceleration. Let's zoom out historically for perspective. Think back to January 2020s after the US strike on Qasem Soleimani. Gold spiked rapidly on fears of escalation with Iran. Within weeks, as direct war did not materialize, gold retraced most of the geopolitical premium. Similarity: sudden escalation headlines, immediate gold bid. Difference: today's backdrop includes structurally high central bank demand and already elevated gold prices. Back then, gold was under $1,600. Today, we're above $2,400. The starting point matters. The higher the base, the harder it is to sustain vertical moves without monetary policy support. Now cross-market signals. Gold at 2,120, firm but not parabolic.